Good to see everybody here. Thank you so much for joining us for this wonderful Venture Flows event. This is one of our most popular events because we sort of talk about the entire sort of life cycle, right? All the way through from like limited partners to the venture capitalists to the startups that they invest in and back up, right? So it's like a lot of fun and really interesting. If this is your first time joining an event run by the Dessal Group, Dessal Group is an organization that's really trying to help, turn emerging managers into like a mainstream sort of asset class. We help new and emerging managers get launched, and we provide all sorts of resources to help those folks really thrive and at their craft. And we do that in a lot of different ways. We have an accelerator, it's called VC Lab. It's sort of become kind of similar to what Y Combinator does but for emerging managers. We have other programs such as the Venture Institute, which helps train new associate level folks to join venture funds. And most recently, we launched a program called the LP Institute, which helps limited partners learn how to invest in new and emerging managers. So we're really trying to make sure that we can help the entire asset class thrive and be really successful. And that's why we do these events, right? We do these events because right now there's not a lot of information on a lot of these different topics that are very important, and we want to sort of democratize the access to this kind of information. So if this is your first time joining us on an event like this, we try to make these events super interactive. So there's a chat on the right-hand side. Feel free to go ahead and say hello and introduce yourself, maybe even post your LinkedIn. That's great. In addition to that, we're going to have a panel today. And what we're going to do is I'm obviously going to ask them a lot of questions, but if you have questions, let's go ahead and add them into the Q&A. So there's a Q&A button at the bottom of your screen. You can add questions there, you can upload questions, and then we can sort of go from there, okay? And I'm more than happy to let you know about this as we get farther along in the conversation, okay? Couple things before we get started. And before I introduce the panel, let me really quickly just read a kind of a classic disclaimer that's sort of standard with these types of events. The content presented today is not directed at any investors or potential investors and does not constitute an offer to sell or a solicitation of an offer to buy any securities. All right, awesome. And with that, let's get the show on the road. All right, everyone. So let's go ahead and get through some introductions. Jake, maybe we can start with you. Can you quickly introduce yourself to the audience here?
Yeah, hi everyone. Good morning. Thanks so much for having me. So Cargo Lab, I'm one of the co-founders of Cargo Labs, and we're a software company helping streamline the trucking insurance industry.
Very cool. Alex?
Yeah, hi everybody. I'm Alex Zorychta. I'm the managing partner of Not Yet Ventures. I've spent most of my career working with student entrepreneurs from universities, in fact, like 12 years in the past. And I've gotten 16 of them into Y Combinator, Techstars, Neos, the best accelerators out there in the world. I myself was a YC co-founder, and I developed a unique way for how to find these great entrepreneurs before they have an investable venture through universities at a high efficiency, and then support them to get into these great programs.
Super cool. And then Jim?
Yeah, I'm Jim Cheng, and I guess I'm the LP on this panel. I am a semi-retired serial entrepreneur. I was in the boring government contracting business, and I sold my company a long time ago, and I decided to find some exciting things to invest in, and I became an angel investor in the early 2000s. Ever since, I've worked as a senior state official and traveled all over the place, and now I'm in Charlottesville with the rest of these two panelists. And I also teach part-time at UVA. I teach business and entrepreneurship myself. And I also co-founded an angel group that UVA alumni investing in UVA-related type startups.
Amazing. Thank you so much, all of you, for blessing us with your presence. Everyone, in case you sort of joined late, if you have questions for the panel, put them into the Q&A and we'll sort of put them out there as it makes sense within the conversation. But let me just kind of start with you, Jake. You sort of briefly touched on sort of Cargo Labs. Can you maybe talk about what Cargo Labs is and how you sort of came up with this concept and idea?
Yeah, that's a great question. So Cargo Labs is a software company, and we're building software to help solve a hair-on-fire problem for the truckers. Today, they want to haul the highest paying freight they possibly can, stuff that pays them 200-300% more per mile than broccoli might. And this freight is electronics, nuclear fuel rods, wind turbine blades, especially high-value freight. And this high-value freight has additional insurance limits on it that 90% of truckers just can't access. The underwriting costs are too high. It's too labor intensive, slow, and insecure for the underwriters to produce per trip policies today. And that's where we sort of changed the game with software at Cargo Labs, is now we can sell per trip, per load insurance that makes them instantly be able to step up their regular broccoli insurance to nuclear fuel level insurance so they can get that higher paying load.
Amazing. And then how did you and Alex meet?
Yeah, so I moved back to Charlottesville in 2022 and got involved with a UVA affiliated accelerator program called 434 Accelerator with David Tuve. I took one of his classes in undergrad at UVA, and he put me and Alex in touch, I don't know, sometime in the fall of 22.
Awesome. And Alex, how did you end up investing in Jake's company? Tell us the story about that.
Yeah, absolutely. So a big part of my the way that I go about things is I like to know the founders, way ahead of when we'd even discuss investing. And so Jake and I had been collaborating in different ways. It actually took me a couple of meetings to figure out what you were doing, Jake. So like that pitch that you just gave is just like, 1,000 times better than where we first were. And once I started to understand what they were doing, I was like, oh, wow, you mean like it could be this? And Jake's was like, yeah, that's what I'm saying. I was like, well, why don't you just say that? But what Jake's we don't see on the call is that Jake's co-founder is actually a veteran of the trucking insurance industry for the last like 30 or 40 years. And so Jake's technical talent and drive combined with his co-founder Harvey's experience and connections and insight into this world, that was what led me to want to work with them more. And then as we were working together, I saw that they were super coachable. They were driven. They were talking to customers and getting out there and really getting into that problem. And so when the time came to invest, it was a no-brainer. And so we've been working together ever since that investment. We meet every week, Jake, right? So it's been a lot of fun.
Wow, every week, huh? That's incredible. It's cool that you all have that level of relationship, especially post investment. That's actually very unique in the industry. So now we sort of talked about kind of the investment of the VC into the company. What I kind of want to go now is from the LP into sort of like the VC, so you can all sort of see the kind of money flow here. So maybe Jim, how did you end up meeting Alex, right? And what led you to sort of support Not Yet Ventures?
Oh, that's a longer story, but I'll try to make it short. I've known Alex for a long time, ever since he was, just like a grad student or a recently graduated student. I wanted him because he's got a great biomed degree, right? And I wanted him to get a real job, but instead he stuck around UVA and helped students, believe it or not. And he got many of them into places like Y Combinator and other accelerators. And so I've known Alex for a long time. I've watched him work with students and how he mentors them and helps them along the path of entrepreneurship. And, it's students, right? So they got some great ideas, but they need a lot of polishing, right? And then afterwards, he got an MBA. I'm telling your whole story. And he found that although MBAs are known for like switching careers and becoming investment bankers and all that, going off to Wall Street, he decided to stay in our ecosystem and help the startups. And he said, look, there's nobody at this early stage, early seed stage, pre-seed stage, I would call it, in the Charlottesville area that's really putting in investment into companies that are scalable and investable, maybe in the future. And he would help them get there. And so as an LP, and a cashed out entrepreneur, I've got a well-diversified portfolio of investments, the really safe stuff. And when you have a diversified portfolio like that, you say, I need to have a little bit of risk capital in their high potential, high risk, but high potential companies. And how do you start that out? Well, one great way would be following some good investors, maybe a fund like Alex is doing, and one that comes in very early where you can get the best valuations and help those very, very early stage, but very promising stage companies.
What a beautiful display of just like how an ecosystem can sort of be developed, right? From like the founders to the VCs to the sort of LPs that are kind of working together and kind of creating these sort of like network effects around a wonderful like ecosystem. So kudos to everybody here for participating in that. And it's just like really, really, really amazing to see. Alex, this is a pretty big undertaking for you though, man. Like, let's just call it for what it is. It's like, this is not easy, right? This is a lot. This is really, really hard. So kind of what led you to go out and start a VC and be in this space,
Yeah, it is definitely not for the faint of heart. As if anyone's been around entrepreneurs long enough, I think the biggest piece of advice that I hear from founders is to new founders is like, hey, you're getting into more than you think. You're biting off more than you can chew. And part of that is that like that new entrepreneur not knowing that and still having the drive to go after it, I think is some of the reasons why they're able to do great things. So for me, I've been working with these entrepreneurs for a very long time, particularly out of these universities. And I was kind of frustrated with like how being within the system of a university limits someone's ability to actually help the really fast-growing entrepreneurs. A lot of the focus has to be on programs that are for the 99% of the student entrepreneurs or wantrepreneurs, as some people will say, who actually don't actually go out and build those companies, even 5 to 10 years out. And so I thought I was done with the industry, right? And then after I got my MBA, I was actually considering going and switching careers, Jim. So I don't know if I ever told you that, but I had met Amazon Web Services when I was during my MBA, and they were looking for a scout at the university. And I was like, well, I know where they all are. And I started talking to them and I said, hey, this approach you guys are doing, I think it's actually not as good as this other one that I developed. Here's the paper I published on this. Here's the metric that I use at scale. And the team was like, oh my God, could you come work for us? I was like, you guys would pay me to do that? They're like, yeah, we want you to do this across like 200 universities across the United States. And so I was like, okay. So I started working there. And working there, I also realized that being outside of a university in a corporation also didn't quite make sense. But I was still, I was still showing that like, hey, I could do this at large scale, and I built all these relationships. So when the opportunity came for VC Lab, which is, I think we're all familiar with, this accelerator for new fund managers, it was a free program to start, right? And in order to stay in, you had to keep actually making progress. But like, it was a no-brainer to sort of just test out the waters of like, hey, if I'm not going to be in a university, if being in a corporation isn't right, how can I work with these great, really early stage entrepreneurs while being able to support myself? Because you can't necessarily like charge these early stage founders; they don't have the money. And so I thought of it as a very new way to sustainably continue doing the work that I was honestly born to do. I keep telling people it's a curse, in a way, because if honestly, like if I wanted an easy life, I would be going and doing something else. So through VC Lab, I think I was given the tools as much as like someone externally to myself could actually help me with this, to actually go and create a venture capital firm that was able to support me to do the work on behalf of LPs like Jim, to find and support early stage entrepreneurs like Jake, to go and build these incredibly world-changing companies that provide a lot of value for the economy. So that's sort of how I got into all this.
A lot of people, for a lot of people on the panel that may be sort of new to this or new to the asset class, a lot of times, they see VCs and they're like, oh, they're so prominent, but really it's the entrepreneur that picks the VC. It's not the other way around typically, right? Especially when you have really good entrepreneurs have more demand than supply a lot of the times, right? And so a lot of times people don't sort of see this. So I just want to like kind of make that clear, and love to pass this one to you, Jake. What intangibles are important to you, in an investor? What do you look for in investors in general? And, maybe you can also mention why you maybe chose to work with Alex.
Yeah, that's another great question. really you can think about investors maybe in two categories, the dumb archetype and the smart archetype investor. So the dumb investor, they don't have very many connections. They pester you with information requests, but don't actually do anything with it. They never really move fast with writing checks after they sign documents. And they're not helpful with sort of follow-on advice and trying to get you to the next level. Well, Alex is the exact opposite of that. Alex is super connected to everybody, from Y Combinator to Techstars to investors, just in ecosystems up in Boston or here or Texas. It seems like he's always flying around the country and knows someone that he could help introduce us to or somebody else, and just wants to constantly bring people together to create value. So that's one great thing about Alex. And other is that he, as you mentioned earlier, it's a little bit rare to have a VC want to continue to help after they put money in. But Alex has been there every week, offering up an hour, sometimes two, where we just sit down and sort of solve the biggest problems for that week for Cargo Labs. And I could go on, but there's just so many great things about Alex. He really stands out as an example investor. He's wonderful to work with.
Yeah, it's really interesting. And Jim, I'm sure you're probably getting these pitches as well from other like GPs, and they always talk about like their value add, it's like a slide and like a kind of a standard slide in their deck. And, a lot of people say stuff, but they don't necessarily sort of execute on stuff. And so I'm super curious to just learn about like your process a little bit more. Obviously, you've been very successful. You've also done a lot of like direct stuff yourself and been involved in a lot of different things in the ecosystem. What are some of the things that you sort of look for when you're trying to pick a fund manager to basically manage your money, right, for a long time? And as you mentioned, this is a pretty, kind of high risk, but high reward sort of asset class. Love to get your thoughts of kind of like your inner thinking in all these matters.
Well, that's right. And, there's the traditional things you look for. However, the traditional things, you have to balance the risk, the reward, but also you got to look at the past performance and the fund managers and what they know and what they've done before. Now, just for me personally, I've done like 40, 50 different angel investments, probably more than that. We all know it's very high risk, and we know like half the companies will probably fail or be zombie companies or something like that. But when they exit with a really high X. So we understand the risk reward thing. And in this case, we looked at past performance, but we're looking at a brand new fund with a new fund manager. But on the other hand, I've known Alex for, 8 years now, and I've seen what he can do with these startups. And he's got this methodology, and part of his value is his methodology of how to pick entrepreneurs and how to mentor them and how to help them grow. And that's really important because, entrepreneurs in general that I've found, a lot of them, they don't take advice very well. They're sometimes lone rangers and all that. So you need someone to say, hey, you may not know this company like Jake, but I've got to know him. I know what he's capable of. I know what his potential is. I know the idea's potential. And so I know his methodology. And I think that makes up for the lack of a long track record of fund management and things like that. And of course, again, this is part of my risk profile for my diverse portfolio. But I thought I'd take a chance on Alex and the fund because I know the ecosystem really needs someone like Alex here in our little neighborhood down here. And I know that he can pick the best companies in the region.
Super cool to see that. It's almost like, not only is there a potential for performance, but there's also like almost like a missionary aspect here that can have a pretty significant impact as well on like the future of the ecosystem.
If I can add, it's exactly what Jake said. It's smart money versus dumb money. And if you have smart money with VCs or investors that really will help, I think that makes a difference, especially when you have a good company like good idea and good management like Jake's company.
Everyone, we want to really send your questions to the panel. I see there's some already coming into the Q&A. There's a Q&A button at the bottom of your screen. Please add your questions in there. You can upvote them, and I'm going to go ahead and send them to the panel as we get going here in the conversation. But again, we're doing this for you. I can go all day. This is a super fascinating discussion, but really want to make this as interactive as possible for you. You did say something, Jim, that I found pretty interesting, right? It's like, you look at sort of like past performance, but a lot of times with new and emerging managers, even if they're like on fund 2 and even in fund 3, right? There's not a lot as far as like data that you can go off of, right? Because they're oftentimes not going to have DPI, so they're not going to have necessarily returns. And if the returns are there, then that means that they're probably not the great returns, because the great returns are these founders that go for the distance and takes you like, they take like 10 years for Jake to take his company public or whatever the case may be. So what are some of the like things that you sort of look for, or what are some of the questions that you sort of ask to sort of get a little bit more comfort around maybe taking a little bit of a flyer on someone that's like starting out as a newer emerging manager?
Well, where Alex is what I guess many people in the audience will know, the valley of death, right? It's very early stage, maybe just some basic funding. And how do you get past that valley of death? And do you have a way of doing it? Because it's so early, want to have, just a good feeling about his methodology and how he can help the companies and his ability to find additional funding. Because I'm also associated with an angel group, we hope to have, some pipeline from his companies too. And so we have a good idea of the companies that we want to see. We want to see companies as an angel group. We're further along. We're not quite Series A, but we're still late seed stage. We want to see companies with little market traction, little revenue, with many pilots and things like that. Companies that have been de-risked. And so I'd want to see, what the fund, the VC like Alex, what his methodology is of de-risking companies, getting them to the right stage. And of course, this is for a very early stage VC. So understanding that he understands how to find the right team and the methodologies to get them de-risked and into the next stage, plus his ability to communicate with future funders like angel groups and Series A funders and firms like that.
That's really interesting. So it also has the potential to be sort of symbiotic for some of your other efforts that you're doing as well with like the angel group and things like that. So there might even be even more sort of like network effects if this sort of works out right, which is great to see.
Absolutely.
Alex, love to turn it over to you. So, love to kind of hear about your diligence process. So obviously you're super early, like as early as they get, as I would argue, right? Like almost idea stage. And so what are some of the qualities that you look for maybe in the founders? What are some of the things that you look for as far as like the company and the company profile? And how do you sort of try to figure out if this person is going to like jive well with your sort of methodology and system process that you've kind of developed, especially post investment with the company?
Yeah, absolutely. So my investment criteria are very, very similar to what Y Combinator has been doing the last 20 years, which seems pretty obvious on its face of what you think they'd be looking for, but actually, and they published, I mean, Paul Graham's been talking about this for the last 20 years as well. But many angel groups out there, and you just heard it from Jim, right? They're not willing to go nearly as early as Y Combinator does. They still are waiting for the de-risking to happen. Whereas what Y Combinator did, back in 2005, their first batch, the Reddit founders were barely even working on Reddit. They hadn't even done anything with it. And he gave them $20,000, which at that point was actually a lot of money. They're now giving $500,000. And Reddit just IPO'd, right? Out of that same class, Sam Altman was also in that first class. And if you haven't heard that name, he's now working, leading OpenAI, right? And so what was it about Paul Graham's methodology back then that allowed Y Combinator to be as good at picking companies as possible? And it wasn't really a fluke. I mean, luck does play into this, but like they found Airbnb, Stripe, Dropbox, Instacart, like the list goes on and on and on. Someone did an analysis of their portfolio. And if you had invested over the last, all the companies Y Combinator's invested in over the last 20 years, you'd have 176% IRR, which may be an unrealistic number because nobody would be able to do that. But still, Y Combinator has far outpunched its weight in ability to find these startups. So what are they looking for? So I'm very familiar with what they're looking for because I've helped so many startups prepare for and get funded by Y Combinator, including one that I co-founded. And so here's what they're looking for, 3 things. Number 1 is a really strong co-founder relationship. A team of probably 2 or 3, not usually a solo founder and not more than 3 people who have not only known each other for a long time, but have hopefully worked on things that didn't work out in the past. Like any good marriage, a co-founder relationship isn't all rainbows and butterflies. You want to bet on someone who's had fights, had failures, right? Things have not gone well, and they've worked it out, and they still want to work together. That's a team that you want to work with. That eliminates a lot of the risk in the early stages, right? Because we know that the founders are going to have to pivot. Most of their life is going to be slogging through mud, crawling through glass and all that. And so you want to make sure that they're going to be on the same page and able to work together in the future. The second one they look for is the ability to make progress rapidly in terms of building a product and also getting sales or user traction. So how this manifests is that if there's a software company, for instance, you're not going to want to hire 2 MBAs from Stanford and Harvard who can't code, who have a lot of good wireframes that they've done user testing on, but they're raising $500,000 to go and hire a development firm offshore to go build it based on the wireframes. It's going to take 3 to 4 months in order to get the first MVP out, right? That's very different from a software company or software founders who can literally build it in a weekend for $0. And then also showing user or sales traction. Let's say they're able to get a $40,000 contract before they built any product. That's huge, right? Let's say they're able to get 200, 300 users on an app within a couple week period. Like, this is the kind of rapid pace that we want to see, because even if they're wrong about the idea they're going after, the fact that they can turn on a dime and make progress in the new direction is, like Jim said, a very less risky way of investing investors. The last thing is, of course, we're looking for billion-dollar companies, but what I'm trying to look for is that the founders have a unique insight, a counterintuitive way of going about this, capturing this market, because, and this is directly from Peter Thiel's 0 to 1 and what Paul Graham talks about with really good ideas, is that, like, by the time anyone else figures out that this is the way to go about it, this team's going to be 5 years ahead, in terms of building their products. Capitalism is about a monopoly, right? Not competition. And as Paul Graham says, the best ideas are often, they often look like terrible ones. So with all of that, that's what I'm looking for in an investment.
Can you maybe also relay that to sort of the relationship you have sort of with Jake here? What would you say is like this unique insight that was like, I gotta go and do this now? And, obviously with Jake, and of course, I'm gonna come back to you as well, Jake, to sort of bring this back home with kind of completing the circle here. But I'd love to get your views on that. Like, do you want to talk about that a little bit, or whatever you feel comfortable sharing in regards to that process?
Yeah, absolutely. So their unique insight was, let me back up a bit. So what Jake is doing really is they're hoping to build the operating system for insurance moving forward. If you're not aware, the insurance industry is still based pre-internet. Like, they still use paper copies, back and forth to get a policy done. At least in the trucking industry, it's like 8 to 10 phone calls over a period of 2 to 3 weeks going through. And that's a feature, not a bug. For a lot of this. So what Jake and Harvey realize is, like, that's actually the feature, not the bug. So if you're going to change behavior and actually bring them into the software world, you need to do it in a way that works with the current industry. And so what they've been able to realize is that by going after this excess cargo problem and a couple of other specialty insurance types first, and getting the insurance agents on the platform to use it, you can then basically make them feel comfortable, I guess, with using this new kind of system, because it's making them money right off the bat. It's decreasing the risk for a lot of these new insurance policies. And as they're building out more features onto the platform, they can become an enterprise resource planning software. Jake, did I get that right?
Yeah, and do you agree, by the way, with the point of that? Do you think that's the insight? That's because that's obviously the investor side, but I'm sure you as a founder probably have other things as well that kind of drove you.
Yeah, that was pretty spot on. We're looking to eventually expand our functionality from these instant per trip things to, we're now starting to talk about weekly and monthly policies with some of the underwriters as of this month, actually, I think this week. They want to start offering some weekly products and also for like FEMA related work, which operates on a work order instead of a bill of lading. Our products right now are tied to the bill of lading, but not the work. So there's some funky insurance stuff we still have to work through. But as we do that with more and more of these insurance clients, we could become the operating system for insurance, like Alex said. So
interesting. And Alex also mentioned like behavior change, right? And behavior change in a legacy industry like in insurance is even more sort of challenging and things like that. And so, usually like when someone goes after a problem like this, they have some hypothesis. Oftentimes the first hypothesis doesn't work multiple times, and then eventually they sort of crack it. Is there sort of any sort of insights or any sort of advice you can give to the founders on the call that are kind of going after this and trying to sort of figure out how to sort of change behavior in a legacy industry, which is, I would argue, one of the biggest opportunities for growth in startups in general?
Yeah, it's a time-consuming process, especially these large enterprises. They're kind of like dinosaurs. They take forever to move and make changes. But if you can get them on your side, they're so cash flow positive that it's worth the mission. I think, but it's definitely pretty time-consuming. You got to call a lot of people, win over a lot of inside people within the organization, so they can sort of be your missionaries that spread the gospel, the good news to the rest of the company.
Yeah, so enterprise sales is pretty key, right? As part of this process, kind of like working through the entire kind of pipeline through the company to make sure that they sort of adopt it.
Yeah, and we're really working on two sides of the market. So the freight industry is one large enterprise amalgamation of different companies. Some of them are trucking entities, some are freight forwarders. These are intermediaries that maybe know a Target and a Walmart, and also the trucker, and they take a middleman fee for connecting those two parties. But a lot of that's still paper driven. It's not software driven yet. A lot of phone calls to, hey, Trucker Joe, can you pick up this load? Are you in Atlanta? Can you do it for 1,500? No, I want 2,000. All right, let's do 7,500. They negotiate over the phone back and forth. And there's not a lot of software in that world or in the insurance world. And just, it's a time-consuming process, but we can add a lot of value when the software does get there. And we think overall this is going to be good for the industry to start adopting some of these more high-tech solutions.
Well, for everybody here, just sort of taking a step back as you sort of kind of have seen the entire sort of kind of ecosystem function here. What Jake is sort of describing here is the exact example of like a venture style kind of company. Okay. If everything works out the plan, right? And they become the operating system for this entire industry, that's a massive publicly traded company. Okay. That's like, and that's just like in the United States, like, let alone if you sort of like take this global or whatever, this can get very big, very, very quickly. Right. And this is the kind of things that obviously VCs like Alex are sort of looking for. This is why LPs like Jim invest in funds, is to find companies that are having this type of profile, and they have the founders that are ambitious enough to want to go after this type of a problem and solve it, which is obviously very complicated and very difficult. But therein lies the opportunity as well. So hopefully you can kind of see that. And also, taking a step back, it's a very sort of optimistic style of investing. It's a very optimistic thing to do, to start a company like this. And if a company like this ends up kind of reaching its full potential, the impact that it has on so many people within the ecosystem is pretty profound, right? And so not only is this going to be potentially a very large company, but it's going to have a profound impact on a lot of people within these industries as well, right? So this is a really neat sort of kind of manifestation of sort of how things can work when like an ecosystem gets together to kind of make things really get to to reach their full potential, right? So kudos to you and kudos to everybody for sort of supporting this mission. There's several questions coming in into the Q&A. Everyone, if you have more questions, please add them into the Q&A and upvote them. I do want to go after the most popular ones. There's a question from Nazar here. Maybe Jim, maybe to you, this is for like new limited partners. How do you have any advice for new limited partners on how to find and connect with sort of, new and emerging managers, or any sort of advice on I guess, sourcing, for lack of better words?
Well, something like what we're talking about today is a very, very early stage fund, and it fits a very special place in someone's portfolio. Like I mentioned earlier, for me, it's because I see a lot of very, very early stage companies, and they come and pitch, maybe have angels, our angel group, and they're just too early for us. And people are really good at pitching these days. They got watch YouTubes, right, and see all the videos, so they know how to pitch, and they all seem disruptive. They all seem scalable and all that in the pitch. Well, we really need someone to filter that. And Alex, unfortunately, he has a job of filtering and figuring out what's really good, because everything looks good to an old guy like me, right? Especially when you're talking about newfangled type technologies. So my advice would be, if you're talking about a certain stage of fund, there's only a certain stage of person that would want to invest in that, right? Some people, say, okay, well, too early for me. So if it's too early, you got to find the right audience. And the right audience may not be your typical limited partner that only invests in real estate or something like that. Now, not real estate's bad, but it's got its own characteristics. But you got to find the right audience. For me, and I think for like Alex's fund and funds like that, it may be more word of mouth, because how will you find, a family office that wants to invest in this early stage? Maybe they do, maybe they don't. It's probably the more experienced investor that sees some possibility in really, really high potential companies. So I still think something like this, a specialized fund like this, it's word of mouth and getting out to the local community and maybe targeting specific people that And unlike a national fund, international fund, those huge things, they can spend a lot of money on marketing. This stage, very early stage, you're talking to the angels, you're talking to the early stage VCs and folks like that to find who can we, who in there has the risk profile to invest in something that's a little earlier stage, knowing that the potential returns could be really, really high.
Yeah, and pipeline and deal flow is a huge factor of that too,
Yeah.
right? Like Alex, how many companies would you say do you see a year on average?
I mean, I'm it's shaping up to be like 1,000 or 2,000 companies that I'm seeing.
Right.
10% of that maybe I'm actually meeting.
Yeah, so so that also plays a huge role as well, and sort of how you think about these managers. Do you want to do that work yourself, or do you want to have someone like Alex sort of do that work, which is really hard, right? Because you have to see lots of deal flow to be able to get to kind of a unicorn potential outcome like what we're seeing here with Jake's company, right? Sri's asking on that. This is for you, Alex. Is sort of a kind of it fits kind of basically what Jim was talking about, but it's like, for a newer and emerging manager, Alex, is it easier to find LPs, a lot of LPs writing small checks, or one or two that are writing very large checks, and how do you sort of think about that in general?
So what's interesting is I don't know if it's about check size. It's more about the kind of LP that's out there. As Mike and Deo have taught me through the program, it's a lot easier definitely to go after bigger check sizes. But you don't always know, right? People don't always wear their investability hat on in public, right? And so I think that a better way to frame this question is that it's a lot easier to go after single decision makers. So like high net worth individuals, angel investors, family offices, possibly if they're very small, and avoid ones that are like larger, more like fund of funds or like sovereign wealth investors who maybe have a more rigid process and would never actually even give you the time of day as a first time fund manager. Did I answer the question there, Mike?
Yeah, and I can't agree more. Hopefully what everybody's seeing from sort of this interaction that we're having with this panel, that alignment is very vital to success, okay? Whether it's the LP and the GP, whether it's the founder and the GP, what you want to be doing is optimizing for maximum alignment, right? Of expectations. Because, Jim mentioned, there might be an LP that predominantly has made a lot of money in real estate and really is comfortable there. Well, that's fundamentally very different than a high risk profile, like especially like like Alex is looking at these companies very idea stage, very high likely to kind of fail, and is comfortable with knowing that he's making a bet with the most likely scenarios that a company might fail, right? And that's fine, right? But a person that doesn't have that risk profile will struggle, right? And then that creates everybody's out of alignment, right? Like, for example, if Jake takes an investor that's sitting there and calling him every week, by like, hey, what's going on? What's going on? Are you going to like exit the company or whatever? That's bad, right? Like that's like taking time that he doesn't need to be wasting, right? On people that are not aligned, So I don't know if does anybody else have comments on this topic. If not, there's more questions coming through.
I guess another thing to think about is that you notice in the case with Jim, I've known Jim for 8 years, right? So the first thing I did when I was thinking about starting this fund, and I keep the key word there is thinking about starting it, was that I went to some people who were my close confidants, like Jim. I went to them first and started talking about what I was doing, and I got a lot of positive response. Saying, Alex, yeah, you were born to do this, right? You've been working on this for 12 years. We've seen your results with these early stage companies. Like, I'm an angel investor myself, and if you started this fund, like, I'd love to be a part of it.
Although I did say that if I were his mom, I'd want him to get a real job first. So.
Did you get the same kind of comments, Jake, as well? When you're telling people you're going to start this crazy company?
Yeah, I may have heard a few over the years.
I bet. Really quick, curious though, Jake, how are you thinking about sort of scaling your company? Do you think you're going to be scaling a lot more like locally, or are you going to kind of scale remote? How are you sort of thinking about scale in general?
Yeah, so initially we want to target the US market, and specifically laser focused right now on this excess cargo problem and also an adjacent problem called the double broker problem. So this is a problem where, let's say I've got a load of tomatoes and I give it to Alex, and Alex promises me that his trucking company is going to deliver it, but secretly Alex actually double brokers it to Jim's trucking company. And Jim's trucking company ultimately delivers the tomatoes, pays the diesel fuel, and to get them there. But at the end of the day, I didn't know that, and I paid Alex. And then Jim's trucking company comes to me 6 days later saying, "Hey, what the heck? Your name's on this document. My name's on this document. You owe me money. And if you don't pay me, I'm going to go after your bond with the state. Once you use the bond, you lose it." So it's this whole mess. And so ultimately, the freight broker or the guy with the load, I gave it to Alex. I have to pay twice, pay Jim's company and Alex's company. So we're trying to build this product that can protect the freight broker against this double broker problem, which the Congress is even starting to talk about now. It's a huge issue. And so basically every load that we give out to the trucker, he pays maybe a $3 or $5 fee. And you just sort of break down what your average losses would be across your entire annual amount of freight. You charge that per load. You collect it inside of this loss liability limiter fund, a special product my co-founder came up with. He's the insurance wonk. And all the money flows in there. And then if you have a claim, you can pull the money out of that to cover the claim. And so we think we can get a lot of traction with that product. And so we're looking to probably move into that next. And that'll help us get the freight forwarders on our side and starting to use our software. And then from there, we have a number of other ideas for ways we can expand.
Fascinating. There's a couple of questions into the Q&A. They're largely directed at you, Jim, and they're sort of, if I was to paraphrase, around sort of portfolio construction. First of all, do you take sort of a portfolio approach when you sort of think about like possibly investing in VCs in general or in other fund managers? And this could be other fund managers too, not just necessarily VCs, right? And is there some like things that are like make you a go, and some things are like avoid, or like get your sort of like kind of signal up like I'm not really sure if this is the right person for me to partner with for the next 10 to 15 years?
So yeah, absolutely. And I think again, it normally would be for track record, right? Normally it's track record, it's team, it's management. A lot of folks I know also have financial advisors. And so if I see something come across, my email or something like that, and I say, I'll have my fund managers look at this. I'll have my financial advisors look at that. The things that I handle myself would be things that I'm more comfortable with, knowing the risk and understanding the risk. So everybody's risk profile's a little different, but I do take a broad view of the portfolio. Maybe not as academic as some people would, but I'm trying to keep a certain percentage in high risk things, but high reward. I'm trying to find the most de-risk things to put my money in. But specifically for this, I just see so many deals come out, and not every deal is going to be good. So I have to make sure that the ones that are good have high enough potential, like you said, a unicorn, disruptive, something like that, or at least have the potential to do that. The things I look out for are, things that are based around taxes or the fad of the day. Okay, I don't want to insult anybody, but I'm just, as an example, maybe a big Gen AI pure play or something like that right now, right? Oh, everybody wants to hop on. I try to avoid those, the faddish type things. I know a lot of people when when these new things come out, they tend to pile on because it's the exciting faddish thing. But in the long run, it's still going to be, law of averages. And a lot of people that I know that are successful will stick with, for example, the traditional ways of financial management and just leave a little for this really, really high risk thing here. So portfolio management, right?
Yeah, you mean you don't want to invest in that recent Gen AI company that raised at a $2 billion valuations, even though it's like 6 months old? Did you see that?
Yeah. Oh, yeah. That's how it all goes. Every new thing gets this huge bump in the beginning, and then if you're really lucky and got in very early, maybe you make some money. But everything tends to come down to the mean at some point.
Yeah, for sure, for sure. I'd love to kind of go through everybody on the panel here, and maybe we'll start with you, Jake. I think I know what you're going to say, but is there any sort of like things that are like you're super like bullish about when it comes to the future of innovation, right? We just sort of talk about AI here. Maybe we're a little too bullish as an as an asset class on AI right now, arguably. But I'd love to just get your views on, is there any things like related to sort of innovation that you're super excited about today? And I'd love to go through the entire panel. Maybe we'll go with you, Jake, first, and Alex and Jim next.
Yeah, that's another great question. So as the freight world has a lot of opportunity for innovation, there's some freight tech companies that started getting popular maybe the last 5 years or so. There's still a huge room or amount of room for new software to sort of come into the space. One example of that is the load board. I think only 18% of freight flows through these load boards, which are digital portals. You can log in, you can see where the load's picking up, where it's dropping off, how much it's worth per mile, all this information, sort of like an Excel spreadsheet in the cloud. But the problem is not much freight flows through it. Most of it's still over the telephone. So sort of driving adoption of these software solutions, there's a lot of opportunity there. And then also from Cargo Lab's perspective, we want to integrate with all these different software players so we can get our access to insurance and compliance information within the load board and things like that, transportation management systems. So we think there's a lot of opportunity both on the insurance side and the freight side with cloud software, SaaS solutions.
Alex, how about you? How do you sort of think about the future of innovation?
Yeah, absolutely. I mean, working in the university world, there's more support than ever for people who want to start companies. And obviously with the internet and like generative AI, like it's easier than ever to learn how to start companies in the best ways. It's easier than ever for entrepreneurs to connect with other entrepreneurs if they want to find them. And then in terms of capital, right, you're seeing a lot of funds, like mine included, right, not only in the US, but globally, that are supporting more and more high-risk entrepreneurs. And so it's not just a US thing now, it's like globally, we're seeing a lot more support for these great companies than ever. I'd also say that right now, it's the best time to start a company, just like in the financial crisis and around the dot-com bubble, like after it burst. These are great times to start new companies. And the same can be said for new venture firms like mine, right? Like I'm going to be deploying capital into these new companies that have a really good chance of being super successful in the end because they're forced to do more with less money. And then lastly, I'm really excited because, and this has been a trend for a while, but like it's cheaper now than ever to start a technology company that can be highly scalable. Sam Altman was just quoted a couple of weeks ago, maybe a couple months ago, as saying that he's excited for the first billion-dollar company to be created that never had any employees. It was just one founder with a bunch of these AI agents. And so I don't know, we're not there yet, but it certainly is cheaper than ever to start a company. meaning that it's going to be more and more and more important for earliest stage investors like my Enduring VC firm to be really good at what we do, identifying founders so early.
Well, I can't think of honestly anyone better than you, Alex, on this. I mean, you were like kind of like the OG, right? With like at web services, Amazon Web Services. This is sort of the beginning of everything that you sort of talked about, and you sort of started seeing this trend kind of proliferate like over your entire life, you know. So it's just kind of really interesting that you sort of brought it home with this thing, because I can't think of anyone better, honestly, to be trying to think about this stuff, you know. So pretty cool. Jim, love to get your views. What do you?
Yeah. Well, okay. I don't want to throw cold water on everything everybody said, but I'm of a little bit older generation, and I've seen all the tech cycles since, the 70s and the 60s. I watched the internet start, right? From a side seat and from the bleachers, way back where. And all technology follows a cycle. And I love it, exactly what Alex said and Jake, that it's the best time, I think, ever for entrepreneurship. You can make $1 billion in your mom's basement if you have a great idea and a great execution, right? But from an LP point of view, yeah, I've made I made enough money. Okay, I've made some money, but I still want to be involved in growth. Okay, so I don't need to put all my money on one thing. I need good managers that can find the trends, spot them, and invest in the right companies. And for me personally, because Alex is involved in a very, very early stage company, I've got my, I've got my money sitting somewhere safe, my main money, but I do still want the excitement of knowing that I got a little bit of money in Gen AI, in autonomous vehicles, and things that fly around like drones. I want to know I have something there, right? I want to know I have something there, and I'm very hopeful that the future, is going to recognize all the potential of all this. But I also know there's always that mad rush in the beginning, and and can we get in early enough, or do we have an interesting enough solution like Jake has for a traditional industry that's forgotten by most other people? There's so much opportunity there. So I'm just as happy with that. It's still exciting for me. And I think, again, like Alex and Jake said, this is the best time ever for small scalable companies to find answers with new technologies to especially areas that are rarely exploited.
Really curious to double click on that. So you have seen almost every cycle, at least in modern like internet like kind of history. How would you compare this cycle to like previous ones?
Oh, this cycle. Well, we don't know yet. We don't know what's going to happen, right? But there's always the dooms. There's always the people that say, "Oh, everything's so disruptive," or the world will come to an end, or something like that. Especially with Gen AI, right? Oh, it's going to become sentient or something. Well, I want to invest in that sentient company as soon as early as possible. I'm hoping Alex can find it, or one of you guys out there can find it. So I'm very hopeful. I think it's as long as we have the guardrails out there, I think everything will be fine. And I just hope to catch a wave on it myself.
And for those of you that have been on these webinars with us, you know that the final question we always like to ask kind of the panel, and maybe we go in the same order, maybe we start with you, Jake, Alex, and Jim, is, knowing what you know now, what advice would you give yourself before you started, in your case, Jake, as a founder, Alex, in your case, as a VC, and maybe Jim, in your case, as an LP?
That the job is always evolving. It asks quite a bit of you, I guess the work asks quite a bit of you, and yeah, the role is constantly changing, and being able to be flexible enough to sort of move and with the changing company environment and people around you, and also like what mission or whatever you're trying to solve. We pivoted a few times before we found this insurance problem that we're really excited about now. So just knowing that it might be a process would be helpful.
Alex?
Yeah, absolutely. As a new fund manager, and I'd said this before, it's going to be harder than you think. It's going to be way harder than you think. And so if you're looking to actually start the new entity, start a new fund, before you are going to actually be able to start it and, you know, pay all the money to organize it and formation and all that, you need to have a lot coming up before that. And I think that what a lot of people don't realize is that you're probably going to have to be full-time on this, not yet even a firm, for maybe 3 to 6 months, right? It's going to be really hard for you to keep a job, a full-time job, while trying to do this, while you get started, because there's going to be a lot of conversations you're going to have with fundraising and getting enough, you know, letters of intent, I guess, to even start the fund. And then on the deal flow side, if you're not already part of like a huge syndicate or like a super angel where people are just coming to you, you're going to need to have that deal flow in order to be able to get those investors to want to come in your fund, right? So that's the first thing. And the second thing I'd say is I would have told myself to do more angel type deals earlier. These don't have to be like $20,000 deals, right? Like every time, just putting in, you know, $1,000, $2,000 or whatever into new companies where there's more and more opportunities now to see that over the course of time, right? If I had been doing more of that 5 to 10 years earlier, I wouldn't have to be relying as much on my deal flow and my unique insight and that. And I can show, hey, here's the angel deals I did. You know, there's like 20, 30 of them, and we've gotten like a huge X on them. I had done like maybe 6 deals before that. And so only like two have exited, right? So it wasn't as powerful as if I had been doing that earlier.
I'm so glad you brought that up. I always tell new managers that you're no different than the founders that you're backing. You're also a founder yourself. Is this that instead of a startup, you're starting a VC firm, right? And but same kind of trials and tribulations, you know. Jim?
Yeah, slightly different approach for me. I think as an angel and an LP, I think one word of advice is everything sounds good, right? Everybody's got a great story. Everybody's got a great pitch. A lot of great ideas out there. A lot of good teams out there. How many will be successful? Not that many. So you need to find a good manager. You need to find maybe more than one, and invest with different, you know, investment themes in mind. So you have that balanced portfolio. And one other thing that does not apply to Alex or his fund is that you got to read the details in the funds. And there were a few funds that I didn't read the details in, and got surprised at the cost. And, you know, hey, we had a 10x exit. Why did I get this little, you know, why is this all that I got out of it? So there's a lot of expenses in funds. Know what they are and know how it works if you have a great exit. Just a couple things, like I said, a little bit different than what Jake and Alex are talking about. But from the LP point of view, got to keep an eye out. You can't expect those spectacular returns without a little bit of cost, because that fund manager and the founder is going to make some money too on a good exit.
Thank you all so much for contributing such wonderful insights. Wow. I mean, I'm seeing this in the chat. I can see people are very, very thankful for your all knowledge. I personally learned a ton from you all. So I just want to say thank you very much for joining us. And, you know, it's really wonderful to see sort of the ecosystem sort of come together like this to kind of see positive change, especially locally as we're seeing it here. So kudos to everybody here for supporting it. And thank you all so much for participating on this panel. Everyone, if this is your first time, we do these every week, these types of events, so subscribe. We'll be doing more events in the future. Alex, Jim, Jake, thank you all so much for doing this with us. Really appreciate your time.
Thank you so much.
Bye.
Thank you.
Thanks for having me.
Bye, everybody.